Hey, how's it going, everyone? Welcome back to another edition of the TIE webinar. We are joined by another fantastic panel of guests this week to discuss one of the most pressing topics for both institutional and retail investors in the digital and traditional spaces. What exactly are RWAs, or real world assets? What does that even mean? How do you tokenize real assets and bring them on the blockchain? All of those questions and more we're going to dive into today. So starting off, I am your host, Jack Melnick, VP of Research at the TIE. Also joining us is Aaron of Goldfinch.
Hey.
Quinn Thompson of Maple, and Colin of Centrifuge. I will quickly read a disclosure that we have to get through, and then after that, we'll start off with intros from our panelists and then dive into questions. If any of the attendees have questions that they want to ask, feel free to submit them in the comments section. No promises on time, but if we have time at the end, we will run through some of those. So starting off, the information contained in this webinar is for informational purposes only and should not be considered as investment advice. I'll go ahead and pause there, and let's start off with Aaron. We can go alphabetical to Colin and then Quinn. Can I get some background? What brought you to crypto and why RWAs?
Yeah, sure. So my name's Aaron. I'm a senior credit manager at Warbler Labs, which is the labs team that's building Goldfinch. The reason I got into crypto is I was previously working at like a traditional finance credit fund to fintechs and emerging markets. And then when I heard about Goldfinch, I just realized that the decentralized approach to doing credit cuts out so many of the fees and also puts lenders and borrowers right in front of each other, putting capital to work in more productive assets rather than going through kind of traditional finance funnels, which sometimes leave some of the smaller businesses and the people who actually need the capital out of the process. So I just fundamentally believe that the crypto decentralized approach to the industry saves people cost and then hands those benefits on to the people who are really driving growth.
Awesome, thanks. Colin, take us away.
Yeah, sure. I worked at a fintech in like 2010 to 2015 called Axial Market, which was trying to connect sellers of middle market businesses, typically 50 million in revenue. So that would be like investment banks, groups like that, to private equity shops. And we saw that there was a lot of opportunity in the long tail of M&A activity and capital raising activity specific to the long tail, like the SME market. And so I did that for 5 years, and I knew if I had a shot to get back in to that space, I wanted to. And so when Centrifuge came across my desk and I had the opportunity to meet the team there, it was a no-brainer. As effectively, Centrifuge was obviously taking on a different market with private credit, but the concept of using technology or the next wave of technology to create more efficient markets and greater benefits to end users, that was something I had to jump at, and that's what brought me here.
Awesome, looking forward to it. Quinn, last but not least.
Yeah, thanks, Jack. So I originally come from a traditional finance, fixed income capital markets background, spent some time at Guggenheim in New York, and then got into crypto full time last year. I was at Abra running our institutional lending desk there. So joined Maple in January of this year to lead growth and strategy. And, really what drew me to it was, working in the institutional debt capital markets, helping corporates and private equity owned businesses raise debt capital, and then, in the crypto credit space. And so I've always had this fixed income thread. And now it's great to have it come full circle as, not only working in the crypto native space, but working with a lot of the credit funds and institutional traditional lenders that I used to touch at Guggenheim.
Awesome. Yeah, I appreciate that color from everyone. And I think it makes a lot of sense why the industry is kind of transitioning in this way and why we see a lot of continued product market fit around these protocols. Before we get too in the weeds on a protocol by protocol basis, I think it's worth taking a step back and thinking about, first of all, why do RWAs matter in this environment? What is a real world or digital asset? And then from there, how do they actually get instantiated, and how do you even invest in this sector, right? So at a high level, let's start off thinking about what's going on from a macro perspective. We see rising rates in the US driven by the Fed. Simultaneously, there's falling demand for DeFi. which means lower organic lending rates for stablecoins on chain. And so for the first time in the history of DeFi, the opportunity cost of moving capital on chain is actually pretty high. And so because of that, we've seen a drawdown and a lot of concern around where product market fit and organic presence will continue to come. From there, RWAs and on-chain lending has really emerged as a primary target, simply because it's a win-win, where yield-starved DeFi investors are able to take their digital dollars and earn good risk-adjusted yield on a relative basis, and traditional companies are able to avoid high costs of financing by raising capital on-chain. And so for that reason, there's already kind of an established level of product market fit that isn't necessarily visible in other areas of the space. So with that as a little bit of context, I'm curious, within each of your respective roles, there's still a little bit of debate around what exactly does an RWA even mean, right? We were having this discussion before the call started. Would love to get a little bit of insight around how each of you view these differently, and when an institution comes to you and is trying to understand what's going on, how do you kind of pitch this solution?
Yeah, I'd be happy to start. So, I mean, I think there is a big white space of exactly what RWA is, but maybe it's better to start with what RWA is not. I think a lot of DeFi right now, probably 95% or more, is basically borrowing against crypto tokens that can be immediately liquidated if the price falls too much. And so basically it's taking the whole idea of credit risk out of the equation. And so RWA, in my opinion, is basically everything else that has to include credit risk and is kind of outside of the space of crypto. And just for comparison, in the traditional finance world, the equivalent of what we consider DeFi now is equity-backed financing. And that represents 1% of total credit markets. So there's so many other use cases out there for how finance can be brought on chain. From our perspective, we like to have exposure that is explicitly outside of the crypto universe, because we believe that offers uncorrelated risk to people who are on chain and looking for DeFi yields. Although I think that varies a little bit by protocol.
Yeah, I think that's right. And here at Maple, I think one of the things we are constantly doing is educating our lender base, our prospect base, because in a conversation last week, I had an investor running a DeFi yield fund mention we don't take counterparty risk, so we don't lend to Goldfinches, Centrifuges, Maple finances. It was kind of funny because in a year where we've got 3 billion plus of hacks, you're always taking credit risk. You can never have, as we've seen with UST, Terra, Luna, the recent hacks, you can't get yield or return with no risk. And so I think there's a big education gap in real world assets. Is basically, for crypto and DeFi to be productive, it has to bridge into the traditional world. You have to be providing corporate credit to real value add use cases. And, at Maple, we've done, 1.9 billion in loans today, just predominantly focused on the crypto native sector. But then, separating what is DeFi, what is crypto, and then what is just technology that makes traditional lending better and allows greater institutional adoption and access to these lending opportunities. And so I think the real world asset is a kind of funny acronym, but and it's very crypto native to bridge the two worlds.
Well answered by both. I think the only thing I'd add is just because of the rising rates environment that we're seeing right now, I think there's a lot of focus on kind of like short-term bonds and U.S. Treasuries across DeFi, whether that be DAOs, treasuries, stable coins, whatever you may see. So I think that's been interesting just in the midst of the economic times that we're in to see that shift. That's the only thing I'd add.
No, it makes perfect sense. And I think that when we're thinking about this space, it's already apparent to me, and I'm sure to the listeners from hearing you talk, that all three of you run really different business models and are simultaneously loosely still engaged in the same basic subsector of digitizing assets, right? And so as we think about each of the different use cases and expand on them further, what is kind of the real reason that either a traditional company or a retail investor or an emerging market startup or something along those lines would want to bring their assets on chain? I think that's a good place to start. And then a follow-up, if you think it's relevant beyond the rates environment, why would there be meaningful appetite for this sort of diversified risk from DeFi investors when they can do that from real investments potentially already?
I think from my perspective, it's really about cost. So the real advantage of bringing an asset on chain is that you're able to put the investors right in front of the borrowers and let them trade right there. I mean, just compare this to what I think has become a bloated supply chain of debt in the traditional finance world. Like a pensioner gives money to a pension fund, they give it to a fund of funds, they invest in a fund, they set up an offshore entity that's tax efficient, they make the borrowers pay $100,000 legal cost, and then the borrower gets it. And so it's like all of these actors have to get paid somehow. That's just their job, right? And so we're in this system that is massively fee extractive and also has so many different layers of risk that it's hard to actually give people the opportunity to be like, do I believe in this opportunity, or is this just the opportunity that's been given to me by my bank? And so the example I use, I talk to people, to borrowers, and when I was working in traditional finance, a lot of my job was sales, being like, here's why we're the right partner, even though there was these costs. Now I talk to borrowers and their eyes like go wide and they're like, how do I understand crypto and make this happen? Because if I could raise all my money this way without having to pay any fees to access the Goldfinch protocol, for example, I would do all my fundraising on chain.
Awesome. Yeah, Quinn, I think let's do you, but you're muted.
Yeah, I think that's a good point. One of the benefits of crypto that we see is it's enforcing people to educate themselves as to their like own financial activities. And so if everybody knew what was inside of their banks, inside of their credit funds, these are black boxes. And as we've seen, the performance and risk management didn't hold up through the summer. And so by bringing the lending on chain, it enforces proactive transparency. If I'm an underwriter saying, well, all my investors are going to see this loan go out the door at these terms to this counterparty with this track record, I don't know if I want to make that. So one of our things we're tasked with is demystifying the risks. Like, we're building infrastructure to optimize lending, reduce costs, and bring access to institutional investors to these different lending opportunities that weren't already available, versus some scary technology that is crypto that's might have these other risks associated with it. But it's really just a tried and true institutional lending concept.
Yeah, I don't think there's much more to add on that point. I guess I would take it more from kind of like the DeFi angle, right? Or for the crypto native set. I think what we're in light of, I think Quinn mentioned 3 billion in hacks or something like that. And we all know what happened with the Lunas and Celsiuses of the world. I actually think we're in a place where we're starting for the first time to hear people, or I'm starting to hear people for the first time talk about things like portfolio construction or risk-adjusted returns. And I don't think that's a fault of like DeFi or crypto. I just think for the first time, we're actually thinking more broadly about this technology and about this ecosystem as not just being a place that you're looking for insane APYs, right? You're actually thinking this is a place that, no, I'm not just going to go into this project or that project with some elevated or escalated return. I'm actually going to think more holistically about how this technology can fit my entire portfolio, right? Or I can get exposure to different return and asset classes through DeFi. And it's really the first time we're seeing that. And I think bear markets typically reveal things of that nature in moments like this. So that's how I'd answer it.
I think you can even, just generally question, has liquidity mining and yield farming worked? In crypto, that's all anybody knows is yield, is free token subsidies to use our product. But then what you had is billions of dollars in digital asset yield funds, crypto credit funds, launching and deploying capital simply to farm, not to actually use the service. So now it's forcing protocols to actually have a real use case. And for us, that's providing credit to real world businesses that need the capital to expand, to invest in their capital expenditures, build plants. I think it's time for the whole crypto native sphere to really question the efficacy of liquidity mining and yield farming, because it's been pretty negative on net. And it's our turn to bridge this gap of what is credit and then what is its interaction with DeFi.
Yeah, no, I think this makes perfect sense. I mean, even over the last week, I've been hearing for the first time other people outside of the DeFi native institutional finance sphere discussing stuff like general accounting practices, fundamentals, product market fit, whereas a lot of it before was, hey, I can emit tokens because I raised a bunch of money and that will subsidize me for a little bit and maybe I figure it out as we go, right? And so there's definitely been an increased transition from nails looking for hammers to actual targeted products. And so when we then think about the way that the RWA stack currently is set up, all of your protocols are really the end user for consumption in terms of who's actually buying these different debt positions or RWA positions. But there's honestly a lot more to it that I'm sure people will want to hear more about in terms of how do you deal with tokenization? From tokenization, how do you source the tokenized assets and get them into your protocol before the end user finally sees them? And so how do you think about the different parts of the tokenization stack? And where do you think the industry is kind of headed over the medium to long term in terms of, are there going to be third parties that do just tokenization and then meet with the protocols? Or is all this going to kind of be done in-house with you directly working with counterparties to help them tokenize and then go to market?
The thing we see at Maple is we're, only institutional borrowers on the platform. And I think it's similar for Centrifuge and Goldfinch, but we're kind of at the mercy as to how quickly legal and regulation can move to keep up. We can't just tokenize an asset and say, this is the collateral underlying this loan if it has no legal recourse. That's one of the reasons DAOs are, that's an impediment to DAOs borrowing, is because there's no legal entity to go after if things go south. And so we're still operating under 1930s and 40s securities laws. And so one of the big impediments to growth in this space and the actual tokenization of underlying collateral is the legal enforcement. And we're seeing some of these issues arise in the Celsius case with their Tether loan. And so, the way we take it is utilize the blockchain infrastructure for flow of funds, settlement, interest payments, amortization, principal payments, and all these kind of mathematical loan functionality pieces. But then we still back up every loan with a legal agreement that has recourse in New York and Cayman, full legal documentation, perfection of collateral, because you still have to enforce. And so, it's baby steps there, but I think we're making progress. And there's a number of other, down the line, you could envision protocols that just focus on tokenizing these assets and the licensing and lien searches. But there's a lot under the hood that needs to get done before we can go full on-chain lending.
Yeah, and just to double down on that, what I would say is there's kind of two worlds, right? There's the primary issuance of assets that we can tokenize, which is what all three of our protocols do. And there's a whole nother world of bringing tokenized assets on chain to do secondary market trading. And as Quinn was saying, the second part is pretty tough until you can actually recognize that these on-chain assets or whatever are true representations and legally enforceable contracts. And so we have to start with this side of the equation, right? We are creating new loans and new assets that are reflected in a normal way off-chain, but we can do some cool stuff with that. So for example, in Goldfinch's case, even though we're giving out a single coupon loan to a borrower, we reflect that in tokens in two ways on chain. One is a senior pool token that kind of accrues interest. And then one is an NFT that represents the first loss capital for a specific deal. And one of the really cool, applications or use cases of being able to tokenize things is that these deals that people weren't able to access before, let alone trade, are now transferable. And you're able to trade these assets on chain. And so these loan agreements that used to only be available for private credit funds, and they're very large institutions, and there's very strict transferability requirements within it that you're not allowed to move it around, have now become freely tradable positions of economic interest, even if the economic interests of that loan still have to be captured, as Quinn said, in real world docs off chain.
Yeah, I think tokenization is just one piece of the puzzle, right? So the digitization of assets has been happening for quite some time. And now the tokenization of real world assets is obviously why we're all here. The way we think about it, or at least what we see at Centrifuge, is a lot of the tokenization work can be done in a lot of different industries, right? It could be in trade finance, it could be in consumer loans. And there's a lot of companies that are already digitizing and some that are even taking the next step in tokenizing. I think where Centrifuge and kind of our infrastructure is best served, right, is helping to securitize, right, those assets and bring them all together and make them into something that's actually investment worthy, right, on behalf of these organizations that are tokenizing. The other piece, right, that we're kind of seeing for the first time is more of the decentralization of your traditional one-stop shop TradFi like banks, right? And as you know, we think about DeFi, but also decentralizing the ecosystem is something that we focus on a lot at Centrifuge, right? Which we actually think will be unlocking a lot of value for Centrifuge as a whole, but also allowing a lot of actors that traditionally haven't been able to participate in these types of economic activities, being able to do that for the first time as we decentralize the ecosystem and create more opportunities for not a single tokenization player, but really unlimited, and those that have specific focus or specific expertise in geographies or asset classes.
Yeah, I think that's the area all of our protocols collectively serve. Although we have slightly different end markets, it's basically industries on an institutional scale that are underserved. We've seen it, the high yield bond was created in the 80s. Securitization became large with MBSs and mortgage backed flowing into the banks owning this market. And then today, over the last 20 years, it's been the rise of private credit because you've had all these regulations preventing banks from holding these assets on their balance sheet and being able to provide credit into emerging industries. And so whether you have crypto, around your business name, but you might be a payments business, or, you're just a company that's too small or middle market to receive larger scale financing, those are the industries we're going to help serve and be competitive in to provide better, lower cost access to capital.
Makes sense. No, that's really helpful. And from here, I think it's worth kind of returning back to an initial point that we made at the start of the talk before diving into how each of your specific protocols does it in a little bit more depth. But as we see now, DeFi markets have meaningfully diverged from traditional markets from an underlying basis yield perspective, right? Like you earn 0.5 to 1.5% lending stablecoins annualized when you can have own money markets with better liquidity, better risk profiles, and kind of achieve the same thing. And so you're asking people to sacrifice risk and liquidity in exchange for composability. And so given that RWAs are able to kind of buck the trend here a little bit, do you see a drop-off in yield of traditional crypto collateralized DeFi as creating an opportunity for RWA? And RWAs are they actually the answer to normalize some of this rate arbitrage that's occurring on-chain versus off-chain?
The traditional crypto interest rate market has largely been tied to trading volumes and arbitrage activity. So when you look at where yields were along DeFi and some of the traditional crypto native lending that we do, it's largely tied to the Bitcoin futures basis trade. And so when you could get a essentially risk-free sell futures, hold spot trade on, you were getting 20-25% yields. And so the rest of DeFi was competing with that within the ecosystem. As prices have come down, people have kind of agreed that that's not more money has flown into the space to close that arbitrage. But then on the yield farming side, people have kind of recognized it's not a sustainable way to scale your business. It's created a gap. We're seeing these market makers and other players be able to borrow kind of the high single digits, but now that's competing with traditional high yield. And it's created a real headwind where 2 years ago, you had institutions from traditional finance searching for yield and coming into the space. And now we're seeing that wave flow out, and it's forcing protocols like Goldfinch, Centrifuge, and Maple to be that bridge that provides crypto native, self-custodied, on-chain investors access to these other opportunities, both from that perspective, but also shepherding in those institutions. Because right now there's cryptos, I don't know if you guys have tried selling crypto products into traditional institutions these days. It's not the hottest thing, but by bridging that education gap and explaining that credit on chain is just a new infrastructure that's not requiring all the manual, back office operations from a bank. It's not tied to crypto prices. It's actually financing real world use cases.
I'll add this. I think it's pretty important. I think the answer is yes, Jack. But I also think that there's a little bit of work to be done, right? Now that people are starting to think about portfolio construction and risk-adjusted returns, right? So rather than just flying from one thing to the next, once they start to look at, in the case of Centrifuge, which is private credit, which is naturally pretty illiquid or will have some duration attached to it, then there's a question of, okay, why would I be investing in this product or this opportunity that sits atop the Centrifuge protocol versus just putting my money into money markets, right? Or just holding it in some treasury bond or some other more liquid instrument. And so now we're getting into the different layers, the different pieces of the world of credit, which I actually think is a great outcome, right? Because it forces a deeper level of thinking, a deeper level of analysis, and forces the entire space to actually be a bit smarter, a bit more thoughtful about how we go forward and how we grow this so that we don't make the same mistakes of the past.
Yeah, the only thing I'd add is that, the changing credit markets and yield spreads blowing up in the real world is a real challenge to us to make sure that we are really honing in on the cost savings of DeFi, right? Like before, this was kind of a niche play within the DeFi space. But if you're getting 4% on US treasuries, we really have to prove out our thesis that access to higher yield opportunities than you can get in your Robinhood app is one reason to go via crypto. And B, the cost savings means that borrowers or investors are getting additional yield and additional alpha from doing it on chain.
And I have kind of a follow-up to that, Aaron. I've had a lot of conversations with Sam, who's a part of your team as well. And one of the points he always makes to me that I find especially interesting is that given our status and given where we work and given even where a lot of the people listening to this probably work, we have a very US-centric point of view that may not necessarily be the case for a lot of people globally, right? And remembering that crypto has a global audience, there are people that don't necessarily have the opportunity to enter money markets, to hold dollars easily, to do all these other things. And so would be quickly interested in hearing, given your global perspective, how some of this kind of ties into demand for these assets over a longer tail period as well.
Yeah, for sure. And me and Sam have been friends for over a decade, and we worked at an EM private credit fund before this. And one of the really ironic things is that, if you're in Indonesia, where I was born and grew up, there's lots of great growth opportunities out there. But for some reason, it's the US and EU credit funds that are getting all the alpha there. There's no real way to invest into these products. And so I think basically crypto being, not caring about where you're based basically gives everybody the equal amount of access to these great yield opportunities that are out there. And so, you don't have to be tied to the various regulatory constraints or the sophistication of the financial markets in your own country. You can actually democratize access to all of these different products and also allow people to invest even $100 into the financial activity and actually see the connection between their investment and like the money getting put to work. I think a lot of people see this massive disconnect between there's the finance world and then there's the growth world. These should be, intertwined pieces of the puzzle. And I think crypto allows the democratization of access and also the flow of funds to productive use cases.
Awesome. Yeah, I think that's exactly right, and very exciting long-term thesis for the growth of the space in particular. And so moving on now and diving into a little bit more depth on how each of your different protocols is structured and how you kind of differentiate, would love to start with Centrifuge and then kind of just go around in reverse order. How does Centrifuge kind of think of itself from a product perspective, from an offering perspective, in terms of what digital assets are actually being offered on the platform? And then from there, how do you kind of use the specific advantages of on-chain structuring to create benefits for both sides of the table?
Sure. So the way we think about Centrifuge is we're just trying to bring the entire world of private credit on chain, right? So we're not really industry specific or geographically specific. If we do focus anywhere, we think the long tail, right, of the SME market over time is where there's the greatest amount of fragmentation. It's the most opaque, and it's the most illiquid because of the combination of those three things. The way we've built the protocols, we have our own blockchain and we have our own app that sits on top of that. And from a building perspective, it's pretty simple, right? It's a two tranche model where you have a senior tranche and a junior tranche. For most of the originators or issuers of debt on the protocol, most of them are holding the entire junior tranche to protect and take the first loss tranche, which also is higher yielding, but also first loss, as kind of a show of their investment and faith in the debt that they're issuing through the Centrifuge protocol. The senior tranche, which is what most investors will take, that's where you're seeing institutions start to participate more and more. I think today there's about 12 to 13 different issuers on the protocol today, and that's everything from carbon credits to trade finance to consumer loans in emerging markets. And it kind of, that will continue to expand and change. I think the other piece of the Centrifuge protocol that's pretty unique is our relationship with MakerDAO and the work that we've done there. We've been working with Maker for close to 3 years now, if not longer. And we were actually the protocol that minted the first real world asset through the Maker protocol, which was probably about 2 years ago. And that was in the residential mortgage space through an issuer named New Silver. So that's the way it works. Investors are going to take, depending on the diligence that they run, they'll either be holding a drop token or a TIN token, and that token represents their principal and interest in the pool that they make an invest in. And then it accrues interest by the second. And when they want to redeem, they redeem it back to at that issuer and collect their principal and interest upon redemption. I think from the investor side, right? Like one point that Aaron made that I think is important to acknowledge is that we're still incredibly early here, right? Like we think about like your traditional private credit funds or even the world of traditional credit or private credit, right? It's at least 4 trillion, maybe upwards of like 5 or 6 trillion now. The Centrifuge protocol is sitting at 80 million today. I'm not sure where Goldfinch is, and probably the same area. So we're at a point where I think from the institutional side, and we start thinking about the institutional investor experience, we're still trying to square peg round hole that, right? Which is like what is the opportunity? What's the unlock that's going to make private credit investing on chain a better experience than TradFi? And I think that's still a work in progress, and that's okay to acknowledge. So who's next?
Yeah, I could take it. So at Maple, our approach is really to, in the same light, bringing private credit on chain, bring the best and brightest credit experts and underwriting teams to the platform. So we've had, spin out banking groups, spin out folks from private credit funds who are looking to do their own thing, or we, joint ventured some different crypto native asset managers with some underwriting teams in the past. And so that allows us to scale into new verticals and industries where we're not going to be the best and have the specific industry expertise to underwrite each one. And so taking our recently launched Bitcoin infrastructure lending pool as an example. So that's basically a fund structure where, investors can come to the platform, deposit their USDC on chain, and in return, they get a, token representation of their pro rata share in that pool. And so all the financial flow funds, new loans, the on-chain enforcement of interest payments, in default occur on chain. So it provides transparent. You can see when every interest payment comes through. It's fully compliant as we KYC and onboard every party that participates. But then we have this off-chain component, which is the underlying collateral. So these loans to Bitcoin infrastructure firms are secured by their data center assets, their infrastructure, their transformers, some land. And then there's also income security on the Bitcoin that they produce. And so it takes the shape of a very traditional direct lending style arrangement, but just taking some of that infrastructure component, back office operational component of funding, settlement, reconciliation out of the hands. And so I'd say it's interesting when we are speaking with allocators, we're often talking to the investment teams because ultimately the firms need to get comfortable with the credit risk they're taking, when also, at the same time, a lot of the benefits that on-chain lending provide are more operational and back office in nature. And so these cost savings that Aaron mentioned that actually reduce the cost of capital and increase returns to lenders because there's a lower take rate and less middlemen. We need to get in conversations with those large asset managers, banking institutions, operation offices too, to let, explain how we can save them millions of dollars a year in legal operational administrative costs.
Yeah, and I just believe there's so many different directions you can go, whether you want to provide infrastructure that helps people recognize or, benefit from these operational cost savings, or whether it's access to different kind of deals. There's so many different directions and places to play in this space. Just to add kind of what Goldfinch's kind of theme is, most of our borrowers to date have been either fintechs themselves or fintech credit funds. I mean, from a conceptual perspective, we think fintechs are a pretty good way to start transitioning into the real world, because these guys are obviously tech forward players willing to think about credit from a technology perspective. And then the other thing that I think is interesting about having that kind of thematic exposure right now, I mean, that's not what's going to look like in the future. We also want to bring other assets on chain, but an interesting aspect of that is that our senior pool, because a lot of these assets underneath are kind of similar within that fintech narrative, our senior pool is a combined senior pool. And so it provides capital to every single deal. And so if you want to go and make an investment into, this thesis with first loss capital protection, diversified across 25 countries and 20 different originators, you simply have to invest in our senior pool token, and you don't even have to redeem interest. It's like a stable coin that increases value over time. We call it FIDU. Its value a year ago was $1, and now it's $1.09. And so I think, to Colin's point about it is incredibly hard to attract institutional capital. And one of the theses we have is that making this simple and giving them kind of an 8 to 10% return on passive capital, not even having to redeem that interest themselves, basically is giving people a simple way to get access to these kind of yields. And we think that that's been pretty advantageous in terms of attracting, as all these other guys have said, the different types of risk tolerance, whether you want that senior pool capital or you want to be an underwriter who really puts their money where their mouth is and takes the first loss on deals.
No, I think that's a great point. And that element of necessary human interactivity is kind of interesting as well, because one of the key points of blockchain and of smart contract tech is the ability for it to actually cut down on a lot of that human necessity and middleware necessity. And so over time, finding solutions for crypto and for RWAs and for DeFi that reduces the amount of interaction with the protocol and stuff like that over the long term is probably honestly a successful use case. And so we're coming up on the last 10-ish minutes of the panel here. So last call for questions if anyone has anything that they want to hear from the panelists, and we'll kind of do a wrap-up question in about 5 minutes or so. But wanted to get to one or two of the questions that were submitted during the talk that I thought were pretty interesting. Start with this one from Simon, who asked about the loan structuring process for RWAs and was specifically wondering about whether or not long-term you see loan origination and processing is going to become fully permissionless as well. This is something that's pretty interesting, given that permissionlessness is a huge focus of DeFi, but sourcing credit obviously involves taking some sort of underwriting risk that makes it trickier. And so would be curious to see how each of you are thinking about this permissionless aspect of loan sourcing over the long term.
Yeah, I think coming back to the point I was making before, which is that making this as simple as possible and scalable as possible is really important. And so projects that we're thinking about working on is, how can we create standard structures or even standard legal documents that borrowers just have in their toolkit and the Goldfinch investors already understand. And so you're able to kind of come at a deal without having to dig into all the very, funky parts of structures for different products. Now, I think that standardization is very important and it'll continue to happen. However, there's always going to be a need for some kind of human validator or auditor in the process. And so I think for all of us, developing a community that has the expertise for underwriting, for enforcement, for, legal documentation and that kind of stuff will be niche expertise that has to be in all of our different communities. But we have to make it as simple as possible and make a standard loan, structure that is the Centrifuge structure or the Maple structure or the Goldfinch structure, so people can just be a bit more fluent about these things rather than having to go through your traditional 300-page facility agreements, security agreements to figure out just where the risks are.
Agreed. I was going to say, I think ever since I've started working in technology, right, like there's always been this fear that technology was going to replace the humans, right? And maybe we get there someday, but I don't think that's where we are right now, right? So I think human validators are always going to be there. The way I kind of interpret what Aaron's saying is like the standardization is actually just enhancing the process and unlocking the ability to do more of this at scale, right? So we should be minimizing, I think, human interaction as much as possible. And I think we'll continue to do that over time, but I don't think it eliminates it. And the third point I'd make is what I think Aaron's calling community. I would just say, I envision that, and we envision that as a decentralized ecosystem. I think it goes back to this idea of creating more opportunity for more players that have been traditionally barred, excluded, or unable to participate for a lot of different reasons, by using a global blockchain and enabling new businesses and new opportunities and new functions to participate in the digitization, the origination, the digitization, the tokenization, the securitization, the underwriting, all the pieces, whatever Asian word you can think of, right? There's going to be unlocks along every end to end for the entire credit journey on chain, if we do our jobs well and realize kind of the mission and vision of what this can be.
Cool. Yeah, Quinn, unless you have anything to add, we can pause there and go to the next question. Specifically, one of the last things I wanted to get to is thinking about, okay, let's say I'm an investor or a liquidity provider, whatever user of the DeFi ecosystem, and I take up a position in one of your protocols. How does OTC and secondary market trading of these positions work, if at all? I know some of your protocols have built out specialized sub protocols and platforms to help facilitate secondary market transfer, but okay, over the short term, if you're an investor, how do you actually deal with transitioning in and out of positions? And then over the long term, do you see RWAs moving towards general decentralized DeFi marketplaces like AMMs, like Uniswap, or to a specific kind of RWA router that takes all of the various yield opportunities across all these platforms and presents them to institutions?
I think eventually you get a pretty sound trading platform or experience for all these different fixed income tokens. The tricky part today is that you first need the assets that can be traded or securitized. And so, a lot of the lending that's facilitated on chain is just not in the billions of size and scale that you need to create liquid secondary markets. The approach we've taken at Maple is to create pools with lockups that mimic traditional credit funds. So like on our long-term corporate credit pools, like the Bitcoin infrastructure, that's a 12-month lockup, and then you can withdraw it. We have some shorter term 30-day lockup pools for shorter term lending. And so eventually, as those scale to a larger volume in activity, you can then create secondary markets for these, and even do things like securitizing and tranching. Because in traditional markets, the largest purchaser of high yield credit is CLOs and securitized tranched out vehicles. But the problem in the crypto lending space today is 80 or 70 to 90% of a CLO is like investment grade rated paper, and that's a cost of capital in the 4-6% range. It's kind of fluctuating today, but that cost of capital threshold and investor base just doesn't exist within on-chain lending today. And so in order to be able to securitize and market these tranches to all the different lender bases, we need to first scale the amount of institutions on the platforms and volumes being flown through, and then it'll create a more fluid flowing secondary market for them.
Yeah, and what I would add is just, I think people need to recognize that you can only get good rates if you give people time with the money to go create some growth out of it, right? So most people in DeFi are just like, let's liquidate immediately. If APRs are above 100%, I'm in the market. If they're not, I'm out of the market. And it's like, that's just, you're collecting free money. That's just not how credit works. And so I think basically the liquidity that you're getting on these loans that are usually highly bespoke and not able to be traded is the cherry on top. But at the end of the day, someone has to be willing to hold this risk, whether, for the duration that the people need it in order to put it towards those economic growth activities. And so I think there's lots of exciting things, and actually the liquidity and secondary trading is incredibly exciting. But as Quinn said, like, you really have to have very liquid markets with high amount of demand and turnover to really be able to recognize that future. But just to think about it a little bit, I think all the things you were saying, Jack, are possible. I think it's possible to have index funds created by purchasing assets on all these different protocols, and AlloyX is one of the entities that's doing that already. You can do OTC trading, you could do repackaging of securities, and basically the composability of the blockchain basically throws into question, why is it that these assets and these high returns have to be siloed into single credit funds in the real world?
Nothing to add. It's pretty good, pretty well covered.
Awesome. Well, perfect timing anyway. We're up on our time limit anyway. Thank you again to all of our fantastic panelists for what was a really informative discussion. If you were tuning in and want to hear more from any of these people, you can find all of them on social media. If you are a fund that wants to get in touch with them to learn more, or a company that wants to learn more about the origination side, you can reach out to the speakers or to me, and I'm happy to put you in touch with them. Thank you again for tuning in, and hope everyone has a great rest of their day.
And big thanks to Jack as well.
Yeah, well done, Jack. Thank you.
Thank you.
Thank you, everyone.